Hello, ladies and gentlemen. I am the Acca Tutor, Jerem Timkulu, and those are my contact details and credentials. In this video, we are going to discuss the workings involved whenever you are confronted with discounted cash flow or capital investment appraisal questions in your accountant studies, particularly the management accounting paper for the Acca or in financial management courses. Okay, so here we are going to select about 7 questions from the week 8 assignment to those to those who are studying with the Transcal Consulting Services Academy. All right, so please stay tuned as I take you through the processes involved. Remember, in this particular week, we were looking at 3 investment appraisal techniques, that is the payback period, the net present value, and the internal rate of return. So the questions which are within this video are those which were pointed out by students to be problematic, and I'll try to take a step-by-step approach as I will be working through those questions. Please pay careful attention to the processes I'll be going through. All right, so let us get straight to the business of the day. Question number 1. A company is investment costing 20,000 and will hope to receive inflows as follows: year 1, 7,000, year 2, 8,000, year 3, 10,000, year 4, 8,000. The company uses a discount rate of 8% and has looked for a payback of 4 years and a discounted payback of 5 years. Cash flows arise evenly throughout the year. What is the payback and discounted payback period? So, for the first part, we have to calculate the payback period without discounting. So we just have to utilize the information provided for the sake of time. Okay, so we can use the figures there, but we can modify to have another column here for the cumulative inflows. All right, so we start with the year 1 cash inflow of 7,000, and we add this one to the 8,000 and we get 15,000 as a cumulative figure, and then we add it to 10,000 and it becomes 25,000. We add this one to 8,000, it becomes 33,000. The idea of payback is when are we going to receive our capital invested. Remember, we invested 20,000, as you can see there. So you can see that by year 2 we had recovered 15,000 only. So in year 3 we had recovered 25,000. So our recovery was between year 2 and 3. So this means that our payback period should be 2 years plus some months. Okay, 2 years plus some months. So how many months are we looking at here? We are looking at the investment was 20,000 minus 15,000. That is the year 2 recovery in aggregate. Okay, which was 15,000. Okay, all divided by the 10,000. Okay, the 10,000, and this means that the payback period should be 2 years plus 20,000 minus 15, that's 5,000, all divided by 10,000, which 5,000 over 10,000, this is 0.5. I mean, we've got this 0 is not crossed, so 5 over 10, this is equal to 0.5. So we are going to have 2 plus 0.5, that is 2.5 years. So in terms of ordinary payback, the payback period is 2.5 years. Okay, so which means from the choices given here, you can see that our possible answers should be C and D. Okay, those are the possible answers, but by the end of the day, we have to pick one which is correct. But in the examination, you can see that the rest have been eliminated and you are left with C and D. Now, let's compute for the discounted payback period. For the discounted payback period, you can come up with a table again as above. So we've got years, we've got year 1, year 2, year 3, year 4, and we've got the cash flows. The cash flows, year 1, we are looking at 7,000 from above, from this information there. So year 1 is 7,000, year 2 8,000, year 3 10,000, year 5 year 4 8,000. Okay, and our discount factor should be at 8% as given there. The discount factor at 8%, we go to the present value tables, we consult the present value tables, and these are our present value tables. Okay, we are looking at the cash flows, the discount factors. What's going on with this pen of mine? Okay, we're looking at 8%. Okay, let me try to erase this. What's going on with this? All right, let me try to highlight everything. Okay, this is the information. Oh my god, highlighters are problematic again. Okay, the 8% has been shaded. Correct. All right, so that's the discount factor. The discount rate and the factors are inside. So for the year 1, we are having 0.96, year 2 0.857, year 3 0.794, year 4 0.735. So we are using that information. So for year 1, that's 0.926. 0.926. Year 2, from the table, year 2, that's 0.857. 0.857. Year 3, 0.794. Year 4, that's 0.735. Then you have to multiply these figures and to get your PV of inflows. The PV of inflow, 7,000 multiplied by 9.26. Let us use our calculators to see if we can come up with accurate figures. Okay, 7,000 multiplied by 0.926, we get 6482. Okay, and then 8,000 multiplied by 0.857, we get 6856. Then 10,000 multiplied by 0.794, that's 7940. Then 8,000 multiplied by 0.735, that should be 5.880. Then we create another column here for the cumulative inflows as above. Cumulative inflows. So we start with the year 1, we just copy and paste. Then this one multiply, adding to that 6482 plus 6856, we should get our 13,338. We add that one to this figure and we get 21,278. Then this one, to add it to that figure, we get 27,158. Okay, so as you can see, our investment was 20,000. So the 20,000 was recovered between year year 2. Okay, this, remember, this is year 1, this is year 2, this is year 3, this is year 4. So you can see that the 20,000 was actually recovered between this, just after year 2. Okay, just after year 2. Therefore, our payback should be 2 years plus. Okay, should be 2 years plus, we do the same mathematics, we invested 20,000 minus, okay, minus this last cash flow before we recover, before the payback, that is minus 13,338, okay, or over this cash flow, okay, this PV, the PV of cash flow in the following year, that is 7940. Okay, this means our payback period should be 2 years, and if you punch these figures, you can see that that's plus 0.839. Okay, and this means our payback period from the should be approximately 2.8 years, the discounted payback. So obviously our answer now should be D. This is our answer. Okay, let's move on to the other question. Let's now attempt question number 3 together. We are just cherry picking, we are not doing everything. All the answers, the full answers were given to our students. They have all the answers. Okay, we're just cherry picking for them to see how these things are done. Okay, and you can benefit as well if you become a student. Okay, or just from just watching, you could be benefiting from this presentation, so you could benefit. Now let's do question number 3 together. Okay, question number 3 is not as confusing as what the majority of students were saying. All right, we are having Mr. A. Collins, who is thinking of investing 20,000 on the 31st of December 2018, and to receive his payment of 25,000. I mean, the repayment of 25,000 from his investment on the 1st of January 2017. And the question is saying, what is the internal rate of return on his investment? Okay, so we need to know how many years are they from December 2018 to 1st January 2017. So let us draw a number line. Okay, today, let us assume today is 31st December 2018. Okay, December 2018. This is year 0. That's today. And then 1 year later, we get to 31st December 2014. This is obviously year 1. Okay, and then we move on another year further. We get to 31st December 2015. That's year 2. And then another year later, 31st December 2016. This should be year 3. Then 1 January 2017 obviously should be considered to be this part, because it's just an overnight distance. Okay, 1 December will be the following day, so it's just the same period. This is the same period we are talking about. This is financial mathematics, so this is just the same period. Okay, so we are talking of an investment over 3 years. Okay, this is a 3-year investment, so our N is equal to 3. N is equal to 3. So the NPV of this investment should be, NPV is equal to the initial cost of the investment was 20,000, okay, plus the PV of inflows. The inflows are 25,000 multiplied by 1 over 1 plus R to the power 3. Why? Because we have to discount the 25,000 in 3 years, okay, because it is going to be repaid in after 3 years. So we have to discount this with a 3-year discount factor, but we do not know this discount factor because we do not know the discount rate. Now the question is saying what is the IRR of the investment? We know that what we know is that IRR is the rate at which NPV is equal to 0. So we have to slot a 0 in this particular equation. So we are saying in this case, for us to get the IRR, the NPV should be 0. Okay, so 0 is equal to minus 20,000 plus 25,000 multiplied by 1 over 1 plus R. Okay, therefore let us remove the minus 20,000 to become positive. So we are saying 20,000 is equal to 25,000 multiplied by 1 over 1 plus R cubed. Okay, so this is 20,000. Now we have to make R subject of the formula, so we have to remove this denominator R. So we have to multiply both sides by 1 plus R cubed. So we are going to have a situation where we are saying 20,000 1 plus R cubed is equal to 25,000. Okay, because 25,000 multiplied by 1 is just 25,000. So okay, then we have to remove the 20,000 from the left side. So we are going to be left with 1 plus R cubed is equal to 25,000 over 20,000, because we have to divide both sides by 20,000. Okay, then because of the space, let's move here. So we are saying 25,000 over 20 is equal to, this can be simplified to 1.25. Use your calculator and you see that that should be 1.25. So our remaining equation is now 1 plus R cubed is equal to 1.25. Now we have to remove the cube power. All right, so how do we remove the cube power? To remove the cube power, we can multiply these powers by 1 over 3. Remember, 1.25 is to the power 1. All right, there is a 1 here. All right, so okay, so this means that we are now having a situation where we are saying 1 plus R is equal to 1.25 to the power third. Okay, we are having to the power third there. Therefore 1 plus R is equal to, let us use our calculators. 1 plus R to the power, 1.25, 1, okay, 1.25 to the power, to the power 1 over 3. So you can just put the 1 over 3 in bracket. 1 over 3. My calculator seems to be problematic. 1.25 to the power in brackets 1 over 3. That's 1.07 1.0772 1.0772. So then it means that R should be, because we have to remove this one by subtracting on the right side, so we are left with 0.0772. Therefore our R should be approximately 8%. Okay, should be approximately 8%. So you can see that our answer should be B. Okay, I hope you are following. All right, I hope you are following, and you could as well use at this stage you can remove the cube power by using the function, by multiplying both sides by this function, the cube root. Okay, you can use this function, the cube root. If you multiply both sides by that cube root, you will discover that on the right side you are going to have this amount, 1.0772. Okay, I hope you have been helped there, and let us move to another question. And I hope this time we have to skip to question, let me see here, question number 7. Okay, let's go straight to question number 7. Okay, a business is considering implementing solar heating throughout its factories. This will cost $900,000 after 1 year, and the savings are estimated to be $400,000 2 years from now, and $600,000 3 years from now. So we are going to have a situation. We are having a situation where in year 1 we are having outflow, okay, 900,000. Then year 2 we are having inflow, okay, that is 2 years from now, that is year 2, that is 400,000 positive, and year 3 we're going to have 600,000 positive. So we are also given the information that the discount rate is 10%. So if we go to our tables, you can see that the discount factor 10%. From our tables, this is the 10% we are talking about. Okay, that's for year 1, that's 0.909, year 2, that one, year 3, that one. So let us load those figures. Year 1, 0.909, 0.909, year 2, 0.826, year 3, 0.751. So the PV of inflows should be the PV of both outflows and inflows, 900,000 multiplied by 0.909, that's 818100. This is a negative figure. And then 400,000 multiplied by 0.826, 400,000 multiplied by 0.826, that's 330, 400. Then 600,000 multiplied by 0.751, that's 450,600. So let us add them up. 330, 400. Okay, minus 818100. So we are left with 37,100, which is negative. Okay, so we are having our answer there as 37,100 negative. So the answer is B. Okay, let's move on to question number 8. Okay, a business will receive rent. Okay, sorry, let me just take you a bit. There could be others who are confused and say, why are you saying the initial investment should be multiplied by 0.909 instead of 1, because we are used to see the investment being multiplied by 1. Now, in this case, the investment is going to be made in year 1's time, not today. If we had invested this 900,000 today, then in year 0, therefore the discount factor was going to be 1. But now the investment is going to be done 1 year later. So this is the reason why we have discounted it with 0.909. Thank you. Now, a business will receive rent of $10,000 per annum on a 999-year lease starting at year 0. So this business is receiving rent in advance. Yes, in advance. Is receiving rent today, not 1 year's time, not 1 year later, but today. Okay. Then at time 2, the business will also receive $1,000 to recover the legal fees involved in setting up the lease. So in 2 years' time, they are also going to receive $1,000. Okay, what is the present value of the receipts in the discount rate? If the discount rate is 7%. Okay, so this is an issue for a modified perpetuity. Okay, it's a combination of a perpetuity and some inflow. Okay, ordinary inflow at a certain point in time. All right, so in this case, we are not going to simply say the perpetuity's value is 10,000 over the discount rate. It doesn't work like that, because this is a perpetuity that has been received in advance. Okay, so the rent PV factor, okay, we are talking of from time, we're talking of a perpetuity in advance. So these are the rental income from time 0. Okay, we're talking of time 0 to infinity. Okay, because a 99-year lease is almost like an infinity. Okay, nobody's going to live for 900 years. So we are simply saying this is an income infinity. Okay, in theory, that's an income infinity. Okay, so in that case, we need to determine the ordinary, the value. Okay, the annuity factor in terms of the ordinary, the perpetuity factor rather. Okay, we are looking at a perpetuity factor. We need the perpetuity factor which is modified. Okay, we want the ordinary perpetuity factor plus 1, because remember, this income is received not 1 year later, but today. It is received starting from today. Okay, the ordinary perpetuity says that the income will come every year to infinite, but after year 1. Okay, that's the ordinary perpetuity, where we would have just put the 10,000 divided by 0.07. But now in this case, we need to modify the formula to say the factor okay, or the PV factor rather. The PV factor is going to be 1 over 0. 1 over 0.07, okay, plus 1. The reason why we are adding 1 is because we are starting to receive income today, okay, rent today. That's rent today, and this one is ordinary perpetuity. The ordinary perpetuity factor. Ordinary perpetuity factor, okay, but the rent is also going to be received today, so this is rent in advance. Or income in advance. So in that case, this is how we modify the PV factor. So you can see that we are going to have a situation where, let me say, 1 over 0.07, we're having a PV factor of 14.2857. 14.2857, okay, 14.2857, okay, plus 1, and this comes to 15.2857. All right, so we then have to multiply this by the income. The income is 10,000, okay, for the perpetuity, so multiply by $10,000. Therefore, the income, the rental income, is going to be multiplied by 10,000, about 152,000. 152,857. Okay, so that's the income from the rental. The rental from the rents. The rentals. Okay, the income from the rentals. So we then have to consider the other income. Okay, we have to consider the other income, which is receivable in year 2, and we are told that we can simply say the other receipts. Okay, and we are told that this is $1,000. The $1,000 received in year 2. Okay, so multiply by 1 over 1 plus Ara to the power 2. Okay, this is 1,000 multiplied by 1 over our Ara is, the R is 7%, so 1 plus 7%, that's 1.07 to the power 2. And if you patch these figures, okay, we are going to say 1,000, okay, multiplied by 1 over 1.07, the power 2, that's 0.873. Okay, 0.873. You can also verify this figure from our tables. Remember, 7% 2 years. This is a 2-year income. So 7% 2 years. This is the 2 years, 0.873. You have proven that. Then you are right on track. Then you can see that the income would be 873. So the question is saying, what is the present value of the receipts if the discount rate is 7%? So you have to add this figure plus this figure, and you must get the total of this figure, which is the solution. Okay, let's move on to the other question. Let me see which question I can pick. Let's do question number 9. Okay, number 9 is saying a business will receive rent of $10,000 per annum on a 999-year lease starting at year 3. Okay, starting at year 3 now. All right, we are going to receive the income starting at year 3. All right, we are not starting in year 1, we are not starting in year 2, but in year 3. What is the present value of the rental receipts if the discount rate is 5%? Okay, here we need to consider a lot of things. So first we need to appreciate that this is income. I mean, this is a perpetuity starting in 3 years time. Okay, starting in year 3. All right, so what it means is the income is like this. It is starting from 3 years to infinity. Okay, so we need to determine at the rate of 5% what could happen if the income was starting from year 1 to infinity. So from year 1 to infinity, the income, the PV factor was going to be the PV factor was going to be 1 over 0.05, which is the ordinary perpetuity. Okay, the ordinary perpetuity formula, and this should give us 20. Okay, that's 20. The factor is 20.00. Okay, 20.00. Then what about if, we need to know the annuity factor. Okay, the annuity factor between year 1 and year 3. Okay, so the 2-year annuity factor, 2-year annuity factor. Okay, the difference, 2-year annuity factor. So the 2-year annuity factor from tables at 5%. We go to the annuity tables. Remember, a perpetuity is an annuity to infinity. Okay, you are going to receive annual income forever. All right, so a perpetuity is another form of an annuity. Okay, but that does not cease. It is going to be there. You are going to receive the income forever. All right, so the annuity tables at 5%. Okay, 5% 2 years, 5% 2 years. We are looking at this figure. Okay, we are looking at 1.859. So this is going to be 1.859. So obviously, if we know that the ordinary annuity from year 1 to infinity is 20,000, and the annuity between 1 and 2, okay, from year 1 and year 2, or rather a 2-year annuity is this one. Therefore, from 3rd year now, we are going to say this from 3 year to infinity is going to be 20.00 minus 1.859. We're going to have a factor of 18.14, 18.141. All right, so we then have to adjust with the inflows. Okay, so you just have to multiply with the available rental income. So that's 10,000 multiplied by this figure, 18.141, and we have to get 181,410. So you can see that our answer is C. Okay, I hope you guys are not grumbling, are not, complaining, you are happy. I just guess you guys are happy. So we are left with just 2 questions because the assignment was very large. So let me just do with you question number 11 and question number 12, and we call it a day. So let's move on to question number 11 and 12. Okay, question number 11 is saying a business has cash inflows of $400 per annum for times 0 to 8 except time 5. Okay, so the inflows are being received for times starting today up to time 8 except in time 5. What is the present value of these flows at a discount rate of 10%? So this is a more interesting question, but we just have to stand on the principles. All right, so we need to establish the inflows. Okay, I mean, first of all, we need to establish the PV factors. Okay, so from year 1 to 8, we need to have the annuity factor there. Okay, because these cash flows are 400 per annum, so we need the annuity factors from year 1 to 8. So the 8-year annuity factor at 10%. So if we go to our tables, we must establish this figure, annuity factor 10%. Okay, I guess these ones are annuity tables. Yes, so 10%. All right, annuity factor 10%, 8 years. We are looking at this figure, 5.335. That's the figure we need, 5.335. This should be 5.335. Okay, then we are also told that except term 5. So except term 5, this simply means that we need the PV factor year 5, PV factor year 5, okay, at 10%. So this should be, we go to the PV tables. Okay, you just have to lead yourself based on the the principle. Okay, so 5 years, I mean, sorry, 10%, 5 years, this should be 0.621, 0.621. Okay, so we then have, because it is saying except, so we then have to deduct, and we get the rightful PV factor to use, I mean, a unit factor to use, 4.714. Okay, once we do this, we then have to consider as well that this is for the ordinary, or let me just say delayed annuity. Okay, because we are receiving the income at the end of the year. All right, this is just an ordinary. annuity or delayed income or inflow annuity. So as the income are received starting from year 0, we then have to say +1, so that our PV factor becomes 5.714. Okay, 5.714. Then we have to multiply with the inflows. Now the 400. Okay, we have then to multiply with the 400. So multiply by 400, and we should get our income as 2,286. So this means that our answer should actually be D. Okay. Okay. The last question I said is number 12. Let us see what this question brings. A business has 5 annual cash inflows of 1,500 per annum starting at time 3. What is the present value of these flows at a discount rate of 7%? Okay, so the annual cash inflows are 5. Okay, starting time 3. Okay, so from year 3 up to starting at time 3 simply means that at the beginning of time 3. Okay, so we are looking at a situation where we are moving from, okay, let me draw the number line. This is year 3, at the start of year 3. Okay, then year 4, year 5, year 6, year 7. Okay, but one thing I want you to appreciate is starting at year 3 simply means that we are starting at the end of year 2. Okay, end of year 2. So end of year 2. Okay, that's the beginning of end of year 3. Okay, so this is the start of year 3. So if we take another year, okay, this is now we have reached, the investment is started. This is 1st January at year 2 there. As you can see, this is the start of year 3 and this is the end of year 3. Okay, so that's 1 year, 2 year, 3 year, 4 year, 5 year. So we are looking at an investment from 3 to 7. From year 3 to year 7. So 3 to 7. Okay. We then have to establish an annuity factor. Annuity year 1 to 7. Okay, this is found in the annuity tables. Okay, you just have to look for annuity factor at 7% year 7. So if we go to our annuity tables, 7% year 7, we get this. Okay, 5.389. All right, 5.389. All right. Um, but this annuity is starting at year 3, okay, at the beginning of year 3. Therefore, years 1 and 2 are ignored. All right, years 1 and 2 are ignored, but we need their annuity as well. So annuity factor 1, 2 at 7%. Let us look at for this in the annuity tables. 7% year 2, we are looking at 1.808. So obviously for the third year to year 7, okay, um, the annuity factor for 3 to 7 should be the difference. Okay, that should be the difference, and this means that we are looking at 3581. Then we have to multiply by the inflows, multiply by 1500, and we get our 5372. Then our answer is B. Okay, so those were the tricks, ladies and gentlemen, you were supposed to have mastered throughout your assignment. Anyway, I hope you have been helped, and you other guys who are not yet part of our ever-growing pool of brilliant students, please consider approaching us, consider becoming our students, so that you benefit a lot from this coaching. Okay, you have to benefit a lot from this coaching. All right, if you want to get in touch with me, I'll always be there for you. Okay, and this is my number. Okay, that's +263 774 596 368. Okay, I'm Gerald or Jerry. Okay, you can get in touch with me anytime and let us engage so that we do sustainable business together. You must finish this hour qualification as early as possible, so there is no justification for you to delay. All right, so don't forget to click the notification bell, to subscribe, to share, to like this video, or to add some comments so that we improve our business processes. Until next time, may the good Lord continue to bless you forever and ever. Amen.